So, good morning, ladies and gentlemen. What a brilliant start that was from Exactpro. Many thanks to them to inviting me today to speak at this event. I've followed Exactpro's success, and it's demonstrated by the fact that ever since they've been around, the LSE has never had an outage as far as I'm aware, and also all their clients. So that is a fantastic achievement that Exactpro has managed to create over the last, I guess, 5-6 years. So let me try and work out how to use this. So a little bit of background about BTA Consulting. We're a capital markets consulting company based out of here, London. This is our clients, over 100 clients, mainly exchanges, CCPs and CSDs, but also some participants and technology companies. We've been around for 26 years. I myself founded it after leaving Pricewaterhouse, where I ran their exchanges consulting group. Prior to that, I was with Merrill Lynch and Salomon Brothers in investment banking. And before that, for my sins, I was a bean counter with Arthur Andersen in London. So there's some bits of this that are going to be bean counting or oriented. So just to set the stage and to think about where we are today in the current market structure, I just want to pick out one statistic which you may or may not be aware of. But in 2008, when the crisis occurred and Bear Stearns was one of the banks that collapsed, and when it was restructured, when they tried to do the restructuring, it was found that more than 28% of the shares that were issued by Bear Stearns were in existence. So i.e., if the issued share capital was X, there was 128% of X in existence or being traded, and people believing they had claims on the shares in Bear Stearns. And that meant there was about $750 million at the trading price of around 2007, 2008 of excess shares being traded. And that existed because with the current market structure that we have, there isn't an end-to-end chain of trust. So there isn't end-to-end reconciliation. There's a high level of intermediation between the legal title of ownership and the ultimate trading of that ownership. And there's no end-to-end reconciliation process. So what we have today, I don't know if this thing has a pointer. Does it have a pointer? No, I don't know. Okay. What we have today is that at the top end of the market, we all know we have the pre-trade risk controls. So here at the LSE, Millennium has a system for sponsored access and DMA management of the processes. And then you have the different venues, cash market venues and derivative market venues. Then in the middle, we've got the so-called plumbing, the central counterparty, which provides routing, novation, and all the margining, netting, and other risk management processes, and attaching standard settlement instructions and enrichment. And then down below that, it passes on the trades to the central securities depositories and or T2S now in Europe, and the RTGS if it's central bank settlement, or commercial banks if it's FX settlement. And then final legal title ends up, in some cases, in registrars, or if it's a commodity in the warehouse. So nothing new. But in that whole process, there is a significant amount of operational risk. So in parallel with that, for the participants, you've got the front and middle office systems integrating with the risk positions at the trading end and also with the CCPs, and then you've got the back office systems integrating with the CSDs and the RTGSs and payment systems, and then you've got settlement bank guarantees guaranteeing all this process. And then if we look where final legal title is held in all of this, there are 7 different locations for this. So if it's a derivative process, settlement takes place effectively. If it's not physically settling, if it's cash settling, it settles in the clearing system. If it's a dematerialized security within, say, T2S or main European CSD, then number 2, it settles in the CSD or T2S. Cash settlement is the best settlement. The gold standard is in the RTGS. Cash settlement of foreign exchanges with the central bank, and then ultimately within the native settlement bank, central bank for that currency. In European terms, so the Napoleonic type environments, instead of final legal title being in the T2S or in the CSD, it's in the back office positions of investment banks, so typically via an omnibus structure. And that poses a counterparty risk on a party. And then on commodities, there's the final legal title to the commodity, if being physically delivered, is in the various commodity warehouse. So this is quite a complex infrastructure. And if you think about it, it's compounded by the situation that it is highly intermediated. So there'll be CSDs, custodians, sub-custodians, buy side and sell side. So a huge level of intermediation, creating this problem that you don't have an end-to-end chain of trust in the current structure. But we all rely on it, and the markets are very, very, very successful. But there is this latent problem that exists. And I think, and I'm going to come on to it in a second, I think there's going to be an additional problem, particularly for the UK post-Brexit, when we're thinking about euro settlement, and I'll pick up that in a minute. So this is just to set the scene of where we are today. I'm sorry, you probably all know all of this, but it's just that we're all on the same page. So what are the challenges with this structure? And then we can think about, once we think about the challenges, what are the potential technology solutions that might help to create solutions to these challenges? So I've already intimated on the first point is that there's a significant level of fragmentation around final legal title and securities settlement. In addition, we basically automated manual processes. So I'm a lot older than most people in this room, so I can still remember the days when there were certificates and things. And we basically just created an automated process of that whole manual process. So we still only have settlement on T+2 or T+3 in some markets, when in fact, you know, it could, with no rocket science behind it, it could actually be instant and real time. And in terms of the control systems, no one knows the sort of level of contagion risk that may exist. So one doesn't know the number of parties that are in the process in terms of a trade, and how many, whether all those parties are going to deliver, whether the buy-in and fails management processes will work successfully. And even then, if you look at, say, Europe, there isn't a consistent standard on the post-trade fails management process. On the cash settlement side, as I mentioned earlier, the gold standard is that if cash is settled in a central bank, then you've got central bank money, and that is the best immutable source of money. However, there is no pre-settlement transparency on whether that cash is going to settle. So even though transactions are delivered to an RTGS on, say, T or T+1 or T+2, they look at those transactions on the settlement date of those transactions, validate them, accept, etc., and they only become final and irrevocable at the time they accept them. So if there's going to be a problem, you only find out at that moment. There's no review in advance of the ladder against the available deposits of the particular banks in the system. And there's a reliance on the central counterparty that in the event that there was a problem, they would sort it out. And the theory is that anyway, even if there was a problem, there's only a replacement cost risk, not a principal risk. So there's a big reliance, because of this highly intermediated process that we're looking at today. There's a big reliance on the whole acting as principal process, where intermediaries act as principal, sell-side intermediaries act as principal, and clearing members act as principal, and the CCP acts as principal. And then, so what this raises is a big queue management risk. So in the event that there was a meltdown and there's an excessive demand over supply, in terms of, i.e. there's a huge amount of trades needing to be settled, and there's only a limited amount of assets, so collateral and or cash. As we saw in 2008, say for example with LCH, they went to the 4th level of the default waterfall infrastructure. So they didn't get all the way through the 7 or 8 levels that they have. And they sorted out the Lehman's and other issues and made sure that all on-exchange settlements took place. But there's a sense of reliance in terms of the different markets on managing the queue of cash, collateral, and securities to make sure this all works. Now, once we become outside the EU in the UK, I wonder if that reliance will still be possible on for the UK, because it'll effectively be a third country in the EU, and therefore will it be able to rely on, say, the European Central Bank to process the queue to save, for example, British banks in favour of German banks if they were ahead in the queue? Who knows? That question hasn't been asked yet. But there is no transparency to that process, and it brings me back to the point that I raised at the beginning, which is that there is no end-to-end chain of trust that one can definitely rely on. The reliance is based on the CCP, they're acting as principal and having all the default waterfall. So for example, last year, if you read LCH's accounts, the average amount of collateral in place that they had at any point in time was 67 billion euros, with the possibility to be double that at any point in time as a contractual commitment with the clearing members. And the maximum during last year was around about 160 billion of collateral that they had in place. So what I'm trying to bring out here is that there's a level of risk that the market is taking, that is assuming that the CCPs are all gonna manage to support the whole trading infrastructure. So in terms of what does that mean? The CCP itself acts as principal, so it is there. It is the buyer to the seller and the seller to the buyer, and it therefore stands in between the two parties and guarantees that trade. And the way it manages to do that is it takes margin, roughly 5% of open positions, depending on the security, and it measures that risk at any moment in time, in real time, and if necessary takes additional variation margin to cover the risk that is in the market. And the continuous assumption is that the stress test that they will do will cover that risk, and to the extent that if you read the LCH accounts, it states that the way they manage the margin, it converts effectively the worst counterparty into a AAA rated counterparty to a 99.7% level of confidence. So it's basically stochastic. It's working out the probability theory of a meltdown and then saying, how are we going to cover this? And But on the OTC side of this, or any position that is settled through an omnibus account where final legal title is held within a participant, there is no, in the current model of the market, there is no guarantee or insolvency protection against the participant. If the participant goes bust and they haven't ring-fenced the securities for in client positions, the investor is effectively an unsecured creditor. So again, that is a big risk with the current system. And then at the other end, on the trading side, the trading systems are basically totally built for speed. So they've all been slimmed down, all the functionalities out of it, and they're very lean and high performance systems, very low latency, anything between 10 and maybe 100 microseconds is acceptable today in the markets. And what they try and do is they try and basically create a multiplier of the trading environment. I don't think they're aiming specifically to do what was discovered on the Bear Stearns stock, and it wasn't unique. There are many other stocks of that which had excess stock in theory in issue. But the idea with the high-frequency trading and the hedging and shorting, etc., is all about trying to create a multiplier in the trading with not necessarily the aim of reaching settlement. So it's all driven around low latency. And low latency means slim functionality, and in today's world, with no possibility of resolving all the problems that or the risks and challenges that we've looked at earlier. So what is required? So there are plenty of views around the world about what might happen over the next maybe 10 or 15 years in terms of an alternative market model. I personally think we need a bit more of a structure which is driven around financial stability, because what you see at the moment is that this sort of boom and bust approach, a 5-10 year cycle of volumes going up, then a crash, and then the whole process repeats. And that has a huge impact on the primary market. So we did some research recently, which, if anyone was at the World Exchange Congress in Budapest earlier this year, I presented, which shows that the average size of a primary market offer, so a listing, has not changed from before the crash in 2008 to today. So there's been no growth, and the number of listings is still extremely low. It's single digit per market on average. If you take the whole of the world's exchanges and the total number of listings per annum, it's single digit per month. So i.e. less than one company is listed per month across the world in each exchange. Of course, this is different here. It's highly successful here in London, but that is not the case all over the world. So let's think about whether the market should be centralized or decentralized, and how this could be structured maybe in the future. So this is a different version of the other diagram. So you've got the different parties and whether you connect them or not. And when you connect them, is it pre or post trade? So one possibility is if you want to achieve a 100% chain of trust from beginning to end in the whole process, one possibility is to drive a model which says that when you trade, you've got 100% certainty of settling. And in which case, what it means is you take the positions in all the different places and actually put them in the trading engine. Now, all of you trading engineers in the room are going to say, well, how could we possibly do that? We would slow it up. But actually, if we applied some other technology to this market, and we advised one major European exchange, and they built a pilot, and they worked with organizations that build all the technology for driverless cars, they managed to effectively do all of this, put in all the positions, trade on actually the positions in the event if you want to short, there are algorithms that work out how to cover those positions and still achieve extremely low latency. In that example, it was sub 20 microseconds. So the idea behind this model, and this is just a possibility, of where the world may go if we are driven by a chain of trust, is to prior to the start of trading on a given day, the final legal title ledgers are loaded up into the trading system. Trading then starts against those positions, so covering the security side, and on the cash side covered by bank guarantees. And an algorithm within the trading engine decides what is available and what can be traded. And it even solves the problem of, you know, if you're buying and selling all day long, this has all been done, and this is live in some markets in the world. So then what happens is, in the trading system, you can still apply all the artificial intelligence that is expected to arrive in the trading environment, and still trade off final legal title positions, still achieve short selling, collateralization, or whatever else of trading positions, so that you get the multiplier. And then what happens is, we have a choice once we've achieved this, is that because if you go down this route, effectively, as soon as you've traded, you've settled, or you can settle, because you're basically claiming against a cash bank guarantee on the right and the securities position on the left. So you've linked up all the different ledgers in the process, and you've managed to get an end-to-end chain of trust. Now, is this possible with the current technology, or do we need new technology? And I know there's a bit of, I think one of the possibilities that could be applied in this area is the use of blockchain. Now, I know there's a lot of hype around it at the moment, and it's still, I think it'd be very difficult to find anyone who knows of a live use case in the financial services market, particularly the capital markets. But I think if we think over time, what it does is it achieves this is on paper, in theory, what it does, is it removes the need for a back office and a huge amount of end-to-end reconciliation. So that would be a massive cost saving to the industry. And we all know that the margins are extremely thin on the industry. Trading and clearing costs are extremely low, you know, below 0.3 or 0.1 basis point for the trades certainly done through this organization here at the LSE. So it would save a huge amount of cost. Arguably, it could reduce the need for intermediaries. So the level of intermediation that I talked about earlier on could be reduced, because there would be the end-to-end chain of trust. And what it does is it basically provides an immutable proof of provenance over the positions that exist within the market, which does not exist today. So what does that mean? The blockchain provides this unchangeable capability, and it also provides our end-to-end record of origin around what has happened to an asset or an asset class or a transaction. So, and then in addition, what it does is it enables the end-to-end business flow to be embedded in the logic behind the process flows. And I think what it does is it changes the risk profile of this, the credit risk profile of the whole market structure, from a stochastic model to more of a deterministic model. So you would only trade if the counterparty had the asset or had a claim on an asset, which was locked in through the process. So you are not, therefore, You are not therefore taking a credit risk, a replacement cost risk, and all the other risks that LCH and other clearinghouses have to calculate. So what that would do is significantly reduce margin requirements. So that would unlock huge amounts of capital that are tied up in margin across the world, and also in collateral. And that margin and collateral would then be available to be used for trading, rather than being used as a deposit, effectively insurance against a fail. So what I think this does is it provides users with the opportunity to decide whether they want to trade and know there's 100% certainty of settlement, and if so, they would lower their end-to-end costs and they would lower their end-to-end risk. And is it achievable? At the moment, it is not achievable. I still am not 100% convinced about the value of, or the potential of blockchain. I've consistently been saying this looks like a solution looking for a problem, and I'm still waiting to find that answer. But I think there's enough money piling into blockchain to solve a lot of the end-to-end integrity side of things and to make it safe. I'm not convinced it'll ever solve the latency issues, but maybe some of that can be solved in other ways. Who knows? I mean, if we look at the engineering around driverless cars, they take significant amounts of data, much higher volumes of data go into a car system, a driverless car system, than is in this process. And they require, I think, below 16 microsecond response time for the whole engine management system to make a decision on whether to speed up or slow down or apply the brakes or whatever. So their requirements are much more risky, because I mean, in the event they get it wrong, then people die when the car drives into people or whatever. So I want to basically, to sum up, what I think is that over time, oh, there's a typo at the top, sorry. Over time, what we're going to see is there's a possibility for all the positions to be loaded up into the trading system so that one trades off the immutable position of truth, and we will still, and this will not lose the multiplier effect of the existing trading models. You'll still be able to short, you'll still be able to day trade, etc. And then what I think there's a possibility is that the majority of settlement would move to T. So that's why I put at the bottom, it'll be trading, simultaneous final irrevocable delivery versus payment. For some asset classes, of course, it'll derivatives, etc. It'll still be a post-trade process. But I think what this does is it'll remove all the fails. It'll remove the tail risk that one has. And given where what we have in the current model is huge amounts of leverage, cyclical behavior, so the market goes up, then there's a crash, and then the economies recover. I think what this will do is lead to a longer term, more consistent growth of the market, because you'd only trade what actually exists. So this is just a view on where the market might go. There's a lot of money going into blockchain. I think it'll be applied to trading systems, etc. Others may disagree, but who knows what will happen over the next 10 years. Thank you very much, and thanks to Exactpro.
Any questions from the audience, Brian? No questions.
Oh, there was one at the back.
Yes, please.
Thank you.
Thanks a lot, Brian. So I more or less understand how blockchain can be implemented in clearing for cash products, for equities. I don't think for derivatives it is possible to do the same thing, because you have to manage positions on quite some time. So
Yeah, I agree with that. I think this would start in the cash markets, and then maybe over time, who knows, it'll evolve into the derivative market. I agree completely.
okay.
I like your statement about the solution looking for a problem. I agree, actually. Are you aware of the Hyperledger project?
Yeah.
Which is the solution looking for a problem, as far from my point of view. So what, from your point of view, would it take to bring that solution to the problem? What is necessary for that to happen?
Well, one is more research, making this technology work. So a lot of these, they still haven't solved things like the latency issue, which I think they'll never solve. But maybe the physicists in the room will know whether they can solve it. But maybe co-location. So in this example, what would have to happen is all the positions, including the investment banks and custodians, would have to be co-located in the co-location center of the trading engine. So that is a big security decision. Will Merrill Lynch put their real positions into a third-party data center? So that's one. So there's a big issue on security, whether the system will have the relevant security. And then that, I think, to solve that problem, there's got to be a bit like, and I just noticed Jim's in the audience, I think it needs a sort of a fixed protocol type standards organization to try and get the industry to agree on a set of standards for this to work. And I know there is one organization in Switzerland trying to do that. So I think it's time. Money, security and trust, and a common agreement amongst the participants that they want to get. This is what they want to do. What would be the driver, I think, is getting rid of the costs. So I think it will wipe out a lot of costs, especially in the whole back office, middle office reconciliation process. I think it will save a lot of cost there because it's auto-reconciling.
Thank you.
Thank you, Brian. Maybe a question linked to the previous discussion. So let's suppose we've decided on the technology and it works. I think the biggest hurdle would be to actually bring everyone together. So how would you imagine this transformation playing out? Because you have to bring together banks, clients, regulators, everyone. How would that transformation actually work? Who would coordinate it? How would that actually get off the ground?
So I think there are one of two ways that might happen. One is through sort of consortia. So you saw the Turquoise Consortia, which is now part of this organization, which then led a whole load of innovation and change and improved trading systems, etc. So maybe a consortia of banks or parties would come together and try and do this. The other is also the regulators. So the regulators across most markets are looking at this. I heard recently also the Bank of England is looking at providing a blockchain component to the next version of the RTGS, so the payment system. So maybe the regulators will trial it in a low-risk area and bring it to market.
But then even if you have this consortia and even if you have this coordination, for example, banks would have to invest to make this happen, right? And even if the business case is clear, everybody understands we will save money. We have lots of examples where people do understand and yet they don't have money to invest, even if they know that they will deliver savings because they have other things to worry about. We will be talking about MiFID. I mean, in my bank,
Yes.
this is basically the only show in town right now in terms of investment, right? So if you try to actually kickstart the transformation like this, people will say, yeah, okay, but we have to shell out some cash to actually make this happen on the ground, each of us, to refit our technology stack and things like that. So how would that work?
So so at the moment, I mean, we're all saturated with regulatory pressure, so we can only do what, you know, the regulators are asking us to do because there's too much coming on. But I think I think the UK should seriously look at this as a mechanism of competing against Europe. I mean, I think on Brexit there's a view that there'll be some sort of equivalence and process that will work, and we'll all be happy, but we won't be married still. We'll just live together. I don't think that's going to work. So I think UK has to think, right, we're going to be on our own. We can't trust the people we were previously married. You know, we're divorced now. We're not living together, and we've got to innovate. And maybe the City of London will kickstart a process to try and get this off the ground. I'm happy to discuss more, but I'm being told 1 minute. Okay.
I think I was allowed the last question.
Okay, all right.
I think the idea of separating trading from settlement is not very new, and I think when I started in this business, I was actually wondering, why is it actually separate? Don't you think there's a legitimate demand of separating these two issues? And for example, if you think about short selling, are there situations where this has to be allowed? That's the first question. And then the second question is, when we're talking about costs, there's a lot of costs involved that could be reduced and so on. I haven't seen a business case for that. So I think our industry is very, very efficient, or has become very efficient. And maybe I haven't come around that business case, but have you seen real numbers?
So the second one, I'll take that first. No, I haven't seen a business case for any of this, and I don't know whether people are doing it. But also the banks are actually investing in this technology, and also they're investing in fintech companies. So more was raised through Bitcoin business this year than has been raised through venture capital, traditional venture capital. So maybe it's going indirectly through the fintech structure. To your first point, if the infrastructure is high performant enough, you don't need to separate positions from the trading environment. You can still short. So when, for example, if you're trying to short and you want it covered, the algorithm can look for collateral, find a borrower, and if this is all sufficiently low latency, so your driverless car type environment, it can find the collateral from a willing borrower and cover the short in real time. It doesn't need to call up JP Morgan saying, would you consider covering me in 3 days? And then say, okay, yeah, you're going to cover, I'll short. This is doable today. So the traditional, because we've automated manual procedures, the traditional separation can then, I think, be reunited. That's my view.
Thank you very much.
Thank you.
Thanks, audience, for your questions. Brian Taylor, BTA Consulting.
Thank you very much.